Every housing crash looks obvious after it happens, but what we're seeing right now is a hidden housing crisis that has already begun that really the media is not explaining and a lot of people are not focused on. But this is the state of the consumer. The consumer is primarily who drives the housing market forward, and right now they're really struggling at levels that we haven't seen since the great financial crisis. There's a lot of distress underneath the surface. So US mortgage lenders are approving higher debt to income ratios than 2007. This is a record high of 39.6% on new originations. What this means is the most debt that somebody has as a consumer, they add up their monthly payments, they add it, they use it against their income that they have coming in each month. They estimate how much the mortgage payment's going to be, and all of their debt outflow, just the payment on their debt, is 39.6% of their income. Okay, well, if you're paying taxes to the government as well, I mean, literally more than 50% of your income is going towards debt and taxes in a lot of cases. And this is drastic because the consumer doesn't have any money left over to be able to buy. And so this type of movement that we've seen from under 31% to 39.6% today, it's higher than 2007 at 38.7%. This is an indicator that the consumer is completely maxed out and it's about to get a lot worse. And we're already starting to see it under the surface, and it's rising to the top. And you're going to be seeing this housing story play out pretty much over the next few months here, and it's going to get worse every single month going into busy season. So look, this is a great chart that shows the personal savings rate versus credit card debt. You can see that the consumer, obviously, if they have the cash and they don't want to use credit, they use their cash. But the consumer right now, because they're maxed out, they're loading up on record levels of consumer debt with credit card debt. And meanwhile, you see the personal savings rate basically trickle downward. And I know this chart only goes to 2022, but in 2026, it's getting worse in some cases when you do the personal saving rate against what happens with inflation. You're at a negative savings rate. So people are getting poorer just by existing while their credit card bills continue to stack up. And this is a massive problem for housing because if you get too high of a debt to income ratio, usually this is the maximum that you can lend on. Some cases up to 45%, you're not able to buy a house. So because there's such a high level of debt, you just literally will not be able to buy a house, and this obviously will destroy demand. Now, we're also seeing unemployment start to tick up just a little bit, and you can see that the credit cards, not only were at record level balances, but we're also at a near record level, great financial crisis level of delinquency. So credit card of 90 plus days delinquent is up to 13.1%, even with unemployment low. So people still have their jobs, they're just defaulting on their credit cards. And usually what happens is you see people default on their credit cards, you see them default on their auto loans, and then eventually they'll default on their house. And those people who bought from 2022 to 2024 at record high prices, and prices are now down with low down payments in areas where there's a lot of new construction, they're stuck. And we talk to those people every single day. They don't have the money. They're living off of their credit cards on a weekly basis. And it's a huge problem that we're seeing people have in their house. They're stuck in a house they can no longer afford. And a lot of people say, well, your housing payment is fixed. It's absolutely not fixed. Insurance cost goes up, your taxes go up, your HOAs go up, the cost of repairs and maintenance goes up. The only thing that's fixed is the interest rate in some cases and the payment that you make every single month. But all those other factors move those payments up. So it's a huge problem. And we're not just seeing the issue with credit cards. We're seeing it with basically every type of loan. Look at this, student loans, right? After it was basically, we didn't have any delinquency for a period of time. The auto loans is a huge issue that we're seeing. We're already worse than the great financial crisis on the auto loan front. And then the mortgage is the last one. This is why we say, hey, credit cards delinquent first, student loans next, auto loans next, and then the mortgage rates and the revolving credit line. So this is an indicator, again, that the consumer is maxed out. They're not paying their bills. And if the consumer is not able to pay these bills, they're not going to be able to go out and buy a house. This obviously impacts their credit scores. We even see this with student loans. A lot of them are tied to mom and dads, that if they default, their mom and dad's credit goes down as well, so it impacts it in multiple circumstances. Obviously, we're seeing the auto loan situation start to move up. You can see subprime auto loans are way worse than the great financial crisis. You're seeing the prime auto loans are not as bad, but we had all these bad loans that were originated during the peak years at peak prices, and these assets on the auto loans depreciate pretty quickly. Again, not necessarily a direct concern for the housing market, but when people are defaulting on their auto loans, it impacts their credit, and these people are not going to be able to go out there and buy a house when they're defaulting on their auto loans. And frankly, this is the scary thing. Up to 78%, I've seen studies range from 60 to 78%, is people living paycheck to paycheck. So every dollar that they make ends up going to taxes or the bank or some combination of the two, or some sort of debt or living expenses. And you can see the South Central areas at 68.2%. You can see the different areas of the country that are living paycheck to paycheck. And a lot of people are just one life event away from a massive loss that could lead to this housing downturn getting worse. And so we see this unemployment rate go lower, but what's not talked about is that's because there's a lot more people who are simply giving up looking for work, and they're just not working. And that this is a scary fact, because again, if they're not working, generally, if you don't have the cash to buy, you're just not going to be able to buy at all and get a loan to buy. So we are seeing a really interesting economy with the consumer. Obviously, with inflation being where it is, it drove a lot of the wealth to the top 10%. We see this massive wealth divide in this country. And then you see the bottom 80% who don't own assets get absolutely crushed. And this is what we're talking about. These people at the bottom, 68%, 60%, are just one life event from a massive loss. And you're already starting to see it in FHA, which I believe is kind of like the new subprime. We are seeing delinquency trends skyrocket from 2022, right? When the Fed started raising rates in March of 2022, it changed the direction of the market and made things tighter for everybody, and inflation continued to go along. So we're not at great financial crisis levels yet, looking back, but we're definitely headed in that direction from an FHA standpoint. And this is a trend that we'll continue to see with the delinquencies and these workout programs that were in place from 2020 all the way up to October of 2025, where you could lump your payment on the back end of your mortgage. Those became a lot harder to do last year. And so we're going to start seeing foreclosures move up. Now, I know a lot of people say, well, there's the foreclosure rate's really high percentage growth rate because it's very low. Well, of course it's low. The government didn't allow basically foreclosures or had these workout programs, so there were no foreclosures for 5 years essentially, and a lot of these different products that are government guaranteed. And now we have a backlog of 5 years, plus all the people who bought during peak prices with low down payments, plus all the occupancy fraud. The Fed came out with a study showing that 33% of mortgage applications that they reviewed during the boom years were occupancy fraud, which basically means they said on the application that the property would be their primary residence, and then they immediately turned it into an investment property. They do that so they can get a lower interest rate. Well, if they're not living in the house, they usually default at a higher level of rate. So this could be the same thing we're starting to see in FHA, where people got an FHA loan, pretended they were going to live in it, and then turned it into an investment property. I believe there's some of this that was accused of Lisa Cook by Trump doing this. There were some Republicans also accused of doing this. So this appears to be a thing that people do. And I'm not sure what the government's doing to crack down on this, but it is a huge issue. Or they turn it into like an Airbnb or something like that. Now, the serious delinquent trends, which is 90 days plus, including active foreclosures, is also starting to move up, right? So we're headed in a direction for FHA. Thankfully, VA hasn't been hit that hard, and regular conventional loans haven't been hit that hard, but FHA is where the struggle is right now, where there's 3.5% down. I expect VA to start to struggle quite a bit more, because usually a lot of people who use VA loans get 100% financing, and if they bought from 22 to 24, then they're likely underwater at this point, especially if they're in the Sun Belt. If they're in the Northeast, no, the prices are still holding because they have a limited supply of inventory. But in the South, in the Sun Belt, where there's mega construction going on, a lot of these people are already under pressure. So look, this is what's happening. This is the data. Foreclosures starts jumping 39.69%. You can see right here, total foreclosure starts So there's people I've talked to in the industry that keep saying this is bad. The banks are gearing up for more foreclosures. They're gearing up for more short sales. They can see it in the servicing books, but the banks will do anything to extend and pretend. And it basically, just like what they're doing on the commercial real estate multifamily side, they'll do anything to not have to recognize the losses immediately and hope that the economy somehow miraculously turns around, even though the state of the consumer is really bad. But this is what we're going to likely see continue, especially in the Sunbelt areas as these foreclosures starts, as people are underwater and they just hand their keys back if they bought at the wrong time or they're experiencing more distress. And if we have some sort of job market loss come through the economy over the next few years, it could really crack the housing market. I think that's ultimately what's going to have this distress come to the forefront. It's under the surface. What'll bring it to the top is job loss. We don't know what's going to cause it. Perhaps it's AI, perhaps it's a recession in some industry in the United States. We'll have to keep watching. But right now, the whole economy seems that it's propped up from the AI surge and the AI companies. And if that doesn't play out the way that we think it will, which we're very optimistic on, it could be a really bad factor for the economy, bad thing for the stock market. The stock market absolutely influences the real estate market and level of confidence, especially in a state like Florida, where there's a lot of retirees who use their stock market gains to live and their dividends to live. So this is something that we're going to be keeping a close eye on and continue to report to you on. Again, this is one of the things that I want to talk to you about, because what the administration was saying was, hey, let's do 50-year loans. Let's extend the loan duration so that way we can make the payment less. Well, unfortunately, when you do that, it actually increases the interest rate that you have to pay, and it really doesn't make your payment lower. In some cases, it can actually make your payment higher. And so that's why they scrapped that plan, because the administration clearly does not understand how economics work in real estate or in bonds, where you extend the duration. Like, it's interesting to me that they come up with these policies. They're trying to find solutions to help the next generation, except they won't let the prices fall. So one of the things you're going to be fighting is the government will be trying to prop up prices for as long as possible. That's what the administration has already said. Hey, we're going to try to solve this housing crisis, this housing shortage narrative, which there isn't a shortage. There's a mismatch of inventory out there. We're pre-supplied mid-level luxury and we're undersupplied starter homes for the next generation. And this is creating a huge divide. And now we have the prices come down at these $700,000, $800,000 price homes, which is good. But the government keeps saying, hey, we want to prop up prices. We're going to do whatever we can. That's why they instructed Fannie Freddie to buy $200 billion worth of mortgage-backed securities, which obviously did nothing. I'll show you a chart of what's going on with interest rates. But it's no different in the car market, right? Car buyers who opted for a 84-month loan, right? Car loans used to be 5 years. Now they're 7 years. Well, now they're underwater. This is exactly what happens. You just get loaded up with debt for such a long period of time. You're basically owned by the bank for the rest of your life. A 50-year mortgage could obviously be the rest of your life. And this is not the ideal situation for a car market or for real estate market. The idea behind the 30-year mortgage for a lot of people was, hey, I'd own this house for 30 years. When I retire, it'll be paid off, and then it'll be free living or just paying taxes and insurance if they want to do insurance at that point in time. And that kind of matches what's going on. But if you do these longer period of terms or you keep refinancing, that game is now out the window. So now people aren't really looking at real estate as an investment right now because they don't cash flow as well because mortgage rates have come up. So not only are we having loan terms go further out, but we're seeing mortgage rates go up. Thankfully, that idea was scrapped and it's not moving forward. But this is something to be thinking about. Car loans are underwater. There's going to be a lot more houses that are going to go underwater as well. And what we've seen was a lot of optimism over the last few years regarding mortgage rates. A lot of people thought mortgage rates would basically go this year all the way down to 5%. I think there's a lot of hopium for people who want to cash out of the multifamily space, cash out of the real estate residential space. But in fact, we're going the opposite way. Mortgage rates are up to 11-month high right now at 6.85%. I think if we crack 7%, the market's really going to slow. And we're moving into the end of the year where school starts and the number of closed and pending sales drop by about 35% from September to December, which will cause inventory to stack up as closed sales slow. And obviously rising mortgage rates will slow it even further because it just knocks out more of the people on the edge who can no longer afford to buy, or people just think it's not a good time to buy and they just sit on their hands, and that's how you have inventory stack up. So it's very likely that we see inventory rise going into the end of the year. I think we will probably see mortgage rates continue to move up, especially with this war that seems to be solved and unsolved every single weekend. I think that more oil prices will stay elevated, and we'll see what the Fed decides to do as well. If they're going to do a rate hike, which is freaking out a lot of people, it's very possible that they hike to try to get inflation under control, as we've been running over the Fed's target of 2% inflation for the last few years. Now, what we're seeing on the mortgage side is also interesting. People are giving up their low mortgage rate, right? You can see the share of under 3% is 20% of people. You can see the 3 to 4% is 30.4%. The share of 4 to 5% is 16.8%. You can see these lines from 2022. Why does this happen? It's because life happens, right? Death happens, divorce happens, disease happens. People trade their houses, they refinance, they cash out, they do things so they lose their rate. And so we're starting to see a dip of people who are throwing away their low interest rate, and the share of, in the blue up here, 22.1%. This is the group of people who have a higher than 6% rate. And because rates are now 6.85% and going higher, we're going to see this share continue to move higher. That's more money that's taken out of the pocket of homeowners and being pushed towards the banks. And so I think this is going to drain the market even more as mortgage rates move up. So this is basically 78% of mortgages have a rate of 6% or lower, which sounds great, but they are giving up traction since 2022. And ultimately, this is the stat that basically shows what happened. In 2020, you could have a family income of $52,000 to buy a median price home in the United States. Now you need $93,000. In some circumstances, I've seen this play out all the way up to $115,000 for a median income. And in Florida, median income is only $68,000 for a household family. So, people are basically making half of what they need to afford the purchase of a home if they didn't already buy one. And this is a massive problem because we live in a payment economy. And if you don't have the money to make the payment, you can't buy a house. And that is why demand is sliding. So this is the chart, right? Contract signings. This is one of the most important indicators. It is a massive red flag. So you can see after the Fed raised rates right here, it crashed the pending contracts, and we're just grinding along the bottom here, and it's going lower. In our local market here in Jacksonville, Florida, we've actually seen contract signings drop 25% from last year, and last year was not historically a great year either. So we are seeing a crash in contract signings here in Florida, and each market is individual, but this is a major flag for affordability, and we're going to see likely that contracts are going to continue to slide going into the end of the year because of the seasonality, and it's going to be primarily rate driven. So what we're keeping a close eye on is that 30-year mortgage rate to see where things go. Every time we see mortgage rates drop by about 25 basis points, we do see a flurry of buyers coming back into the market. So the buyer is hypersensitive to that right now. And frankly, the market's changing already, and it's not just Florida. Yes, Miami is having issues, but this is the number of home sellers outnumber by buyers by percentage. So you can see there's a lot more people who are looking to sell their home than to buy. Miami, Nashville, Tennessee, Houston, Texas, San Antonio. So a lot of these boom markets that we saw during 2020 to 2022 period are now the ones that are crashing the hardest. And a lot of that is because the prices got so high that the migration basically started changing directions. And a lot of people who are going to move to these states moved there, and so it pulled forward demand, and now we have a gap. So there's multiple factors at play here, but there is a affordability crisis through the consumer. The consumer's in bad shape, and it's rolling over into the real estate market in real time right now. I expect these trends to continue until prices correct to where they need to be, which is going to be a slow grind. I don't expect something that's going to happen overnight. It's going to be years and years and years for this story to play out, but we can see it already starting to change directions right now. So I'd love to hear from you. What do you see happening in the next 6 months? Where are you located? Drop a comment, subscribe to the channel. I do one recording over the summer every single week, and I'd love to hear from you what's happening. If you have any questions, drop a question. I answer every question. If you want to email me, you're looking for a house, you need some advice, I respond to every single email. And of course, if you're looking for a top real estate agent, let us know. We can get you in touch with one of the top real estate agents in the country. We're more than happy to, or in your area, we're happy to do the research for you and connect you with somebody if we don't have somebody inside our tribe that can help you. But appreciate you following the channel. I always talk about I can't talk about everything here on YouTube, so if you want to follow me on Substack, you can subscribe to my Substack as well, John Brooks at substack.com. Appreciate you following, and I'll see you next week. Look forward to hearing from you.